Policy has to remain actively disinflationary to ensure a durable alignment of headline inflation to the target rate of 4% while supporting growth. I would now like to focus on the liquidity and financial market conditions. Like most other central banks, the Reserve Bank had injected additional liquidity into the system to counter the COVID-related onslaught on our economy. Consequently, the size of the Reserve Bank's balance sheet had expanded significantly. Persistence of such expanded balance sheet far too long could have created macroeconomic and financial instability. It is worth noting that the Reserve Bank has successfully reduced its balance sheet size well in time. Illustratively, the size of Reserve Bank's balance sheet swelled to 28.6% of GDP in 2020-21. With modulation in liquidity in the post-COVID period, the balance sheet size moderated to 23.3% of GDP in 2022-23 and further to 21.6% in the current financial year up to December 1. We consider this as a significant achievement. System liquidity as measured by net position under the Liquidity Adjustment Facility, that is LAF, turned into deficit mode for the first time in September this year, after a gap of nearly 4.5 years since May 2019. Deficit liquidity conditions persisted during October and November, prompting large recourse to marginal standing facility, that is MSF, by the banks. In parallel, utilization of standing deposit facility, that is SDF, has also been high. The overall tightening of liquidity conditions is attributed mainly to higher currency leakage during the festive season, government cash balances, and Reserve Bank's market operations. Driven by these autonomous factors, system liquidity tightened significantly compared to what was envisaged in the October policy statement. Consequently, the need to undertake auction of OMO sales has not arisen so far. The evolution of liquidity conditions has been in alignment with the monetary policy stance. More recently, however, as government spending has picked up and system liquidity has got more evenly balanced among market participants, pressures have eased and the net LAF position has evened out broadly. Going forward, government spending is likely to further ease liquidity conditions. On our part, the Reserve Bank will remain nimble in liquidity management. Now, different segments of the financial markets have witnessed monetary transmission of varying extent. Long-term G-Sec yields have softened, reflecting strong demand for these bonds from financial institutions and softening of global bond yields. In the credit market, monetary policy transmission is still working its way through the system, and the supporting data is provided in the footnote. With regard to standing facilities of the Reserve Bank under the LAF, we have noticed, as I pointed out, we have noticed simultaneous high utilization of both MSF and SDF by the banks. This was also pointed out by me in the last monetary policy statement. We propose to address this situation and have therefore decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30, 2023. This is an important announcement so far as the banks and the liquidity situation is concerned. So let me just read it again. We have decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30 this year, that is December 30, 2023. It is expected that this measure will facilitate better fund management by the banks. This measure will be reviewed after 6 months or earlier if needed. The Indian rupee has exhibited low volatility compared to its EME peers in the calendar year 2023, despite elevated US Treasury yields and a stronger US dollar. The relative stability of the Indian rupee reflects the improving macroeconomic fundamentals of the Indian economy and its resilience in the face of formidable global tsunamis. Recently, the Reserve Bank and the Bank of England have signed a memorandum of understanding on cooperation and exchange of information relating to the Clearing Corporation of India, which is a central counterparty that is regulated and supervised by the Reserve Bank. The MOU will enable the Bank of England to assess CCIL for recognition as a third country CCP, that is central counterparty, for UK-based banks to clear their transactions through CCIL. This MOU is based on the principles of mutual cooperation and trust among the regulators of both the countries, that is India and England. We hope the regulators of other jurisdictions also accept these principles. Financial stability, I would now like to just focus briefly on the aspect of financial stability. Financial stability, as we have stated before, is a public good. The Reserve Bank judiciously uses micro and macroprudential tools to safeguard financial stability. The recent preemptive measures taken by the Reserve Bank in respect of banks and NBFCs were geared towards addressing potential risks and preserving the resilience of the financial sector. We do not wait for the house to catch fire and then act. Prudence at all times should be the guiding principle, should be the guiding philosophy, both for the regulators as well as the regulated entities. I now propose to turn to the external sector. In October this year, both merchandise exports and imports came back to the expansionary zone. Services exports remained buoyant during the second quarter of this year. India has remained the top remittance receiving country. The net balance under services and remittances is expected to partly offset India's